Hi, it's Madison Kize. In the first section of company-owned policies, we looked at company-owned policies and income tax consequences. On the second part, we're going to look at company-owned policies and estate duty consequences of basically looking at the end when there's been a death. Now, this obviously doesn't look at things like investment or disability benefits or severe illness, because estate duty is only levied at death, so it's purely focusing on the death benefits. So if we look at the first example where Angie, where policy has been taken out on the life of Angie as a fringe benefit policy, if Angie passes away, that R1,000,000 will be paid over by the insurer to Angie. Now, because it's a death, let's say, for example, Angie had nominated her estate as the beneficiary. So assuming that, let's say, under property, when we're doing a very simplified calculation of estate duty for Angie. So let's say a property is worth R1,000,000. Now, as the policy pays in to her estate, it becomes a deemed property. Deemed property, and it's also worth R1,000,000. Now, again, without factoring in deductions and all of that, that means basically right now Angie's estate is worth, the gross estate is worth R2,000,000. Now, that's if the policy is payable to her estate. What if the policy was payable not to her estate, however, to Angie's spouse, for example? Let's say Angie's married, she's got a husband. Now, again, Angie's got a R1,000,000 property. The policy on Angie's death pays out, but now not to Angie's estate. It actually pays directly to the spouse. Doesn't even hit Angie's estate. We still recorded it as a deemed property because it's a payment of via life policy, and the estate is worth R2,000,000. The gross estate is worth R2,000,000. However, further down under deductions, because we know that the policy is now payable to a spouse, the Section 4Q deduction will apply. In other words, we will minus the R1,000,000. So it will later come off here as a deduction. So that's the Angie's gross estate, before you carry on the calculation, is actually sitting at R1,000,000. So if, for example, the policy was payable to a child and not the spouse, again, it will be like the first example where there is no exemption by Section 4Q. It will basically stay in the deemed property and no Section 4Q deduction, and therefore levy or attract estate duty. So now, in terms of looking at the second policy, we're looking at the key person policy, where the benefits are paid by the insurer to the company AB Construction itself. What are the tax consequences there for estate duty purposes? So in terms of the key person policy, let's say something happens to Angie, she passes away. Now, the insurer will pay over to AB Construction that R1,000,000. Now, because the policy was on the life of Angie, and this is how estate duty works, so property, again, for Angie, let's say it's R1,000,000, and deemed property, because the policy, domestic policy, is paid out, is again R1,000,000. So at this stage, we're sitting with a gross estate of Angie of R2,000,000. Now, before we carry on, if we want to, because further down the line, the same R1,000,000 could actually qualify for a deduction in terms of the Estate Duty Act. Now, what are those requirements for this in order for us to qualify for the deduction? That means that, firstly, in terms of the contributions, that Angie herself must have not asked or requested that this policy be put in place. So the policy must not have been at a request. It must have been purely AB Construction worried about suffering a loss in the event that Angie passes away. And then secondly, in terms of the contributions, Angie herself here must have not paid for the premiums. So as you can see here, AB Construction, the company, has always been paying for the premiums. And then in terms of the actual benefits that pay out, this 1 million rands that pays out on the death of Angie, one of the requirements is that the employee Angie, her relatives, so the policy cannot benefit any of her relatives. So that could be, for example, child, spouse, dependent, that kind of stuff. That policy cannot benefit any of our relatives. And relatives is quite broad because it also includes the whole concept of family company. In other words, I've kept my example quite easy. So Angie is not involved in the shareholding of AB Construction. If, for example, Angie was also the sole shareholder of this company, then that could be deemed as a family company because she's a controlling shareholder. Therefore, that policy fails that requirement of the policy proceeds not benefiting a family company. Therefore, it will stay in as deemed property and not qualify for a deduction later on. So because in this case, Angie is not a shareholder, we just kept it simple. So the policy doesn't benefit any of the relatives because we know that the beneficiary on the policy is AB Construction. And secondly, the company is not a family company, as Angie is merely an employee and not a shareholder or a managing director or anything like that. Now, I'm flying through these requirements, but I do discuss them in much more detail in other videos. But I think for now, it's important just to see how the 1 million rands flows for the sake of the state duty. So because of all those different things that I've listed, the last one is that the policy must obviously not be payable to the estate of the deceased. They've just made that as a specific, clear requirement. So our policy, we know it's not payable to relatives or a family company, and it's not payable to the estate of Angie. It's payable to AB Construction, so we've met all the requirements. So in terms of this policy, because we've met all of those requirements, it then qualifies for deduction in Angie's deceased estate. Remember, this is Angie's deceased estate where we just calculate the estate duty. So because it qualifies for that deduction, Angie's estate therefore remains at 1 million rands and is not affected by the payment of that key person policy. So at the end of the day, without going into detail with the different requirements, I think you see that the difference between the fringe benefit policy that it obviously benefits the employee, Angie, and all the relatives and so on. And you will see that when it comes to the key person policy, there's a real big distinction drawn between the benefits of the company, the policy benefiting the company versus benefiting the employee. Here, key person policies are always for the benefits of the actual company, and they only use Angie in our example as just really the life assured. So something must happen to Angie, which, and then obviously with the loss of Angie, there's a loss to the company, and then therefore the company benefits. So Angie is really just the life assured in terms of my example, and that will kind of make it clear or make it easy for it to qualify for that estate duty deduction. I hope it helps. We can only make points of reference. There's obviously thousands of permutations and different examples we could use. It's just really to make a point of reference for the discussion. We could never finish the topic otherwise. I hope that helps. Thanks.